Hi there, welcome one and all to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day, and today we're going to be talking about options trading mastery, vertical spreads, and two-legged strategies for today's markets. All right, and in this webinar, we will go through how you can discover how vertical spreads, strategies that balance risk and reward through buying and selling options at different strike prices can help you navigate diverse market conditions, from volatile swings to more stable trends. We will also break down real life examples and dive into powerful two legged strategies like straddles, strangles, covered calls, and protective puts. Plus, learn how to apply these techniques to adapt to events like the US elections. Incidentally, it's just hours away, and economic shifts and global market changes, helping you make smarter trading decisions. Don't miss this opportunity to discover endless possibilities in the world of options and enhance your options trading skills. All right, so you're here in the right place to learn all these techniques. And who do we have in the studio to tell us more about options trading? We have Danish Lim, investment analyst with Philip Nova. He covers quite a number of different products. His expertise lies in equities, equity indices, forex, commodities, and options. He frequently shares his views and opinions through daily market commentaries that are sent out to customers. Danish is also well versed in technical analysis, and his views and commentary are regularly published in the Business Times, Lianhe Jiaobao, and The Edge Singapore. Okay, Danish, if you are all set and rigged up in our studio, I can hand the time over to you. All right, there you are. All right, Danish, I'm gonna give you sharing rights right now. I believe members of the audience should still be coming in, but I think we can kick things off and then they can tune in right after. Okay, so I'm gonna make Danish the presenter right now. Before I hand the time over to him, can I just do a quick check? Maybe can I request that members of the audience you go to the question box or the chat box and type in and let me know if you can hear me loud and clear. Yes, if you just type in yes if you can hear me loud and clear. Okay, just head to your control panel, which is on the right side, and type in the question box or chat box if you can hear us loud and clear. At any point in time during the webinar, if you have questions, you type them in the question box and Danish will pick them up soon after. All right, great. Being, thanks for confirming. Ken, thank you so much. All right, Danish, we're good to go. The floor is yours.
All right, thanks, Sri. So I'll go ahead and begin today's webinar. So today's session, I'll mainly be talking more about option trading strategies. I believe some of you may have joined last month's session, where I mainly covered like covered calls, protective puts, and things of that nature. So before we proceed, just a short disclaimer that this presentation is intended for general circulation only, because we do not take into account your specific investment objectives, your financial situation, or your particular needs. So this is an outline of today's webinar. I'll kick things off with an introduction, and then I'll talk more about option vertical spreads, how they work, some examples, as well as some option strategies that we can use in the current market conditions, especially with the upcoming US elections, where I believe the first polls will close about tomorrow morning, about 6 to 7 a.m. or so. So it's a very exciting period, and for option traders, this kind of volatile periods could we actually prefer periods of high volatility, and I'll talk more about it later on. So again, this is a summary of some basic option strategies that I covered last month. We went through things basic like things like longing a call, shorting a call, protective put, covered calls, as well as a caller. So this is what I'll mainly be covering today. We have the straddle, strangle, and short strangle, as well as the 4 different vertical spreads at the bottom over here. These four option spreads are also vertical spreads, and they are pretty much very similar, except of certain minor differences. So I hope you guys are ready. Today's webinar could be a little bit more content heavy as well. So do prepare your phones in case you guys need to take some pictures. So the first things that I've also addressed in last month's webinar is why should an investor go about executing all these complicated option strategies. Frequently, traders may ask, what's the point of going through all the hassle of executing all these different option combinations when I can just simply buy a stock or simply go long a futures contract. So there's a lot of reasons. Firstly, option and option strategies provide risk management. Strategies like protective puts as well as covered calls can provide you with downside protection as well as generate income when markets are flat. Option strategies also give you a lower cost way to go long or short the market, and this can be done via the vertical spreads, which I mentioned. Other than that, option strategies also provides you with the ability to profit in any market conditions. And we can even achieve profits without relying on price direction. Again, option strategies also provide you with income generation. Strategies like covered calls help you generate additional income uh, alongside your existing positions. And lastly, of course, like the name suggests, I believe options provide you with the ability to customize, your trade according to your own specific market views. For example, covered calls, option callers provide you with yield enhancement, and they are best suited when markets are, mildly bullish or when they are very flat and range bound. We also have straddles or strangles, which I'll be covering today, and they are best suited when markets are very, very volatile, or the opposite, or when the markets are very calm and they are not very volatile. Of course, we also have other strategies like iron condors and butterflies. I won't be covering this today, perhaps another session as well. So let's kick things off and talk about some option strategies. I would like to go through the most basic, option payoff. I think this is important to keep in mind moving forward. So when you long a call, the main view that you're having is typically an investor who goes long a call is that they are bullish on the market. And it's a very simple formula to keep in mind. How do you calculate the payoff to a call buyer? It's through the formula S minus X. S is the underlying price, X is the strike price. And a very simple way to remember this is that when you go long a call and you exercise your call option, you are essentially exercising your rights to buy the underlying. It could be a futures contract, it could be a stock, whatever it is. You're exercising your right to buy the underlying at the strike price. So when you buy the underlying at the strike price, it's essentially you're paying money, so it's a cash outflow. So essentially you can remember this formula by having the negative sign in front of the strike price. And the idea is that you buy the underlying at the strike price and then you sell it at the higher market price, which is why this formula, I think it's an easier way to remember this formula as well. So for call options, the main goal again is that you believe the markets are bullish, and when the underlying price is above the strike price, typically we say that the call is in the money. And on the other hand, if the underlying is equal to the strike price, we say that the call option is at the money. And if the underlying is below the strike price, we say that it's out of the money. For at the money and out of the money options, the payoff is zero because as a call buyer, you can very simply just not exercise your call option. Of course, at the same time, the option payoff is not equal to the profit because we have to remember that as option traders and option buyers, we need to pay the option premium just to own the option. So this is the profit formula where we simply take the payoff, which is S minus X for calls, and then we deduct the call premium. On the other hand, for long put, you simply just flip the previous formula. Instead of S minus X, the formula is strike price minus the underlying price. Again, much of the same, the payoff on your put is not equal to the profit because you have to take into consideration the option premium. And this is the formula for a profit to a put buyer, which is the strike price minus the underlying minus the put premiums that you're paying out. On the other hand, let's say what about a call writer? Let's say you short a call. Typically, call writers or option writers, their main view is that they're bearish or they're neutral on the market, and their main goal is that they want to generate extra income. So the profit and loss, formulas is very simply you add a negative sign to the payoff or profit or loss for a long call. Again, you have to keep in mind that if you are shorting a call or if you're a call writer, you are essentially at the opposite end of the trade, uh, you know, to the call buyer. So when the underlying is above the strike price and if the call option is in the money, as a call writer, you're actually seeing a loss because you need to deliver the underlying to the call buyer. And the loss for a call writer is given by this formula over here. The best case scenario for a call writer is when the call option is at the money and when it's out of the money because the option will not be exercised and you can continue to receive your premiums. However, I think I've mentioned this as well last month. As a call writer, it's we typically say that it's not a very healthy trade to write calls without having an underlying, because you can see on this diagram over here, it's a profit and loss diagram. This profit and loss diagram is very, very helpful. The y-axis is the P&L and the x-axis is essentially the price of the underlying. You can see that the P&L on the right hand side of the graph essentially and theoretically extends to infinity. And this essentially means that your maximum loss is unlimited because the underlying price can go up to any amount. And this is why typically we say that traders have to be very, very careful if they were to short a call option. And this is also called a naked or uncovered call. So how do you exit a short call position? This applies to most of your other option positions as well. Firstly, very simply, you can just wait for your option to expire. If the option is out of the money at expiry, you can continue to retain your premiums. On the other hand, if it's in the money, you have to do what we call assignment and you need to deliver the underlying to the call buyer. If you don't have the underlying, you need to buy it in the market at a higher price just to deliver it to the option buyer. Another way to exit a short call position will be to buy back the call option. And this is essentially closing out your short position. And it is very possible to profit by doing this because of a concept which we call theta decay or time decay. And what we call theta decay refers to the concept where as an option approaches expiry, its value will eventually go to zero. So essentially, the idea is that thanks to theta decay, it is possible to buy back a call option at a lower price if it is still out of the money. Lastly, you can also exit a short call position by simply rolling your position with a later expiration date or a different strike price. So I think it's a very big important question as well. Frequently newer option traders, they see the risk in shorting call options, and they ask, why would anyone in the first place even short options, given the risk that's present in all these short option trades. And this is because option sellers, according to a lot of studies, they actually have a higher average win rate compared to option buyers. You can see that the data from the OIC say that option sellers have a win rate of 60% versus buyers at 40% over the past 15 years. And this is actually pretty true. I believe more experienced option traders may know of this, that the reality is that markets, they tend, or they are mostly, they don't see frequent periods of volatility. Most of the time, markets are rather flat. They are rather, calm. They're rather range bound. And this is where the option sellers can benefit, where option sellers benefit from their options that they are shorting not being exercised, and then they will benefit from receiving a continuous option premiums. So this is an important thing to keep in mind. Shorting options and selling options is a very viable strategy, provided you are aware of how to properly manage your risks. So then the question becomes, when should I long options and when should I short options? Again, very simply, a very good time to go long a call or long a put is when volatility is high. Why? Because when you long a call or long a put, you want the underlying price to move above or below your strike price. So you need volatility in order for the underlying price to move. If it's not volatile, if the prices of your underlying may move maybe about 0.3%, 0.5% every day, and that's not very conducive to a long call or long put trader. On the other hand, it's better to short options when volatility is down or when volatility is declining, because there's less risk of your options positions being exercised by the buyer, and because of this you can continue to receive premiums. So I hope you guys have understood this concept. It's very important. This whole concept of volatility for an options trader, volatility is not your enemy. It can be your friend. So just to summarize some of the strategies I've covered last month, for a short call or naked call, typically the view is bearish, and very simply how to execute this strategy, you simply go short call, but the downside risk is that your potential loss or your maximum loss is unlimited. It theoretically stretches out to infinity. On the other hand, your maximum profit is capped. You can see on the left hand side of this chart over here, it's limited to only your premiums that received. And on the other hand, for a covered call strategy, typically traders will execute this if they are flat or mildly bullish on the market. How do you do this strategy? You long a particular underlying, and then you essentially go short a call. So this is why it's called a covered call, because you have the underlying, already in your hands. So again, the risk, there is still a risk, but it's not unlimited. Maximum loss is when the underlying price goes to zero. And this loss is slightly offset by the premiums that you're receiving. On the other hand, your reward, you receive some upside participation due to your long underlying position as well as your premiums. So I also covered the covered call strategies, and this is a table to summarize some of the exact characteristics. Again, the market view for a covered call trader, they're typically mild bullish, and the main goal for a covered call trader is for yield enhancement. They want to generate income for their existing positions, and to do so, you simply go long an underlying asset, and then you sell a call option. On the other hand, I also covered other strategies like protective put, or what we call a merit put. The main goal is to protect your underlying asset against losses. You have a long underlying position as well as a long put. You can see that your risk will be kept. You can see over here on this chart on the left, the green line, which is the P&L line, essentially becomes horizontal, and this is important to keep in mind going forward. If the green line is horizontal, it essentially means that your risk or your reward is limited. On the other hand, your reward is theoretically unlimited as well, but it will be reduced by your premiums. And what I mean by that is that your total reward or your total P&L will actually be lesser than if you were to very simply go long and underlying. So let's say gold prices, it went up by 20%, but with a protective put position, your 20% in your underlying gold asset will be reduced by the long put and the premiums that you're paying. So instead of 20%, you maybe will earn like maybe about 18 or 17%. On the other hand, we also have callers. Callers are executed by traders who are moderately bullish. They want to protect their profits as well as reduce the cost of the position. This is what we call a three-leg strategy. So there's three different positions, and you can see that both your risk and your reward is limited. I know it's kept on the upside and it's kept on the downside. So what is the whole purpose of a caller or option caller? Very simply, again, you are more bullish and you want to protect your losses. So let's take a look at a case scenario. You're assuming that investor, he already had a long position in gold futures, and as we all know, gold has been risen by I think over 30% year to date. So in this scenario, an investor he's already earned over 20% on his gold futures position, and he wants to hold on to his profits, but at the same time, he also wants to protect his profits. So he decided to set up what we call a costless collar or a zero cost collar. So, although he believed in the potential of gold in the long term, due to all the various factors like rate cuts, central bank buying, geopolitical tensions, he is also worried that a lack of clarity over Chinese demand, a slower rate cut trajectory, as well as U.S. election uncertainty could weigh on gold prices. He believes that a further surge in gold prices looks unlikely, given that it's already rallied over 30% this year. So, what can he do? Uh, in the same time, he also sees support at about 2,600 and resistance at $2,800. So this is from technical analysis. So, however, let's say there's a sudden de-escalation in the Middle East tensions, and the price of gold suddenly drops to $2,400. As I've mentioned, to execute a costless collar strategy, you have to go short and out the money call, and then you long a near at the money put. And the key for a costless or zero cost collar is that the premiums on your short call position and your long put position should be equal. The premiums you receive will be $10 on your short call position, and the premiums you pay on your long put position will be $10 as well. So in other words, the proceeds of your call can be used to pay for the put option. And in this scenario, the total premiums or the net cash flow is actually zero. So you're not paying any money to have this position. And in reality, this could be a little bit difficult. Rather than zero cost, it's more likely that you will achieve little cost or small cost. It's usually quite rare to have a true zero cost collar. So let's take a look at this example. Three scenarios. Let's say gold falls below the put strike of 2,400. We see that the long put position will be in the money, while your short call will be worthless. Again, this is a zero cost collar. So because your long put position is in the money, we can essentially ignore your short call, and the payoff of your long put position, again, as I mentioned, the formula X minus S, strike price minus underlying, your payoff from your long put will be $200. And your gains from this put position will offset your losses from your underlying. You can see over here that without the collar, you will actually see a loss of about $250, and this will eat into your 20% profit. However, with a costless collar, your net position or your net loss will be limited to about $50. On the other hand, let's say it's in between both strike prices, it's between 2,600 and 2,800. You see that the profits of your costless collar position will be the same as your underlying position. However, the downside again is that if you are wrong, you are wrong, and that gold actually rises above 2,800, what we see is that your profits will be limited. Without the collar, your profits will be $250, but with a costless collar position, your profits will be at $150. So that's something to consider as well. And this is why I say the costless collar is typically for traders who want to protect profits that they've already made on the underlying, and they still want some participation, and they have a very strong resistance level that they believe for example, gold prices will not breach. So well, that was quite an introduction. I'll move on to talking about vertical spreads. So when we talk about option spreads and vertical spreads, option spreads are just like any other financial spreads. We essentially combine a long position in one option with a short position in another option. So the two legs of an option spread will always have the same underlying asset, for example, gold, S&P 500 futures, as well as the same option type. It can be two calls or two puts. So there's a lot of different types of spreads. There are what we call vertical spreads, where the options have different strike prices. They can also have different expiration dates, which is what we call calendar spreads. Those of you who trade, futures spreads, I believe you may be familiar with calendar spreads for futures, or both. And it's a more complicated spread, which is what we call diagonal spreads. So one example will be bull call spread, which I'll be going through. So for vertical spreads, essentially the main idea is that it gives you a directional bet, either bullish or bearish, but it comes with lower risk. So when you see the name or the term bull spread, essentially you're bullish on the market and you earn profit if the underlying prices increase. On the other hand, a bear spread, you will profit when the underlying price drops. And spreads, one of the biggest benefits is that they can reduce the net cost of entering a trade. So there's three terms or two terms you need to remember. One which is called debit. Essentially, when we say a the debit spread strategy, we say it means that there's a net cash outflow via premiums paid. So you're paying premiums, cash is going out. On the other hand, another term is credit spread strategy. It's a net cash inflow. So you're receiving premiums. And a very, very important concept, especially when it comes to vertical spread, is that the fact that in the money options, it could be call, it could be puts, they will have higher premiums. Why? Because in the money options, they are essentially already exercisable. And therefore, call writers, they essentially need or they demand a higher premium to accommodate them for additional risk. And this is why, if you are familiar with option chain on most trading platforms, if you were to see the option chain, you will see that in the money options, they typically have higher premiums. So let's talk about a bull call spread. It's also called a debit call spread, and you will see the word debit. Essentially, your cash outflow, so you need to pay premiums. For traders who are doing a bull call spread, typically the market view is that they are moderately bullish and they expect to see a mild increase in the underlying. The payoff diagram is I provided here on the right. You can see that it's similar to a costless collar or an option collar. Uh, Upside and downside risk is limited. Risk is kept over here, and then you can see the upside is kept over here as well. So how do you execute this strategy? You go long and in the money call with a lower strike, while at the same time you go short on and out the money call with a higher strike. So it's important to remember the higher strike price is a short call position, and the lower strike price over here is a long in the money call position. So there are certain rules if you were to do a vertical spread. Both options must have the same expiration date. If not, if not, they will become a diagonal spread or a calendar spread. And the short call has to have a higher strike price. Otherwise, it will be what we call a bear call spread. So your short call over here has to have a higher strike price. So again, for a cash flow, because this is a debit call strategy, there will be a net cash outflow, and one reason is because you are essentially going long on an in the money call. And remember, I mentioned in the money options have a higher premium, and because you are going long on an in the money call, you need to pay a higher premium for your call option. So this higher amount that you pay essentially will be higher than your the premiums that you receive on your short out the money call. And why is it higher? Because out the money options have a lower premium compared to in the money options. So I hope you understand this concept. In the money options have higher premiums than out the money options. So when do you use a bull call spread strategy? Typically, again, is mildly bullish on the market. For example, let's say you view or you believe that the E-mini S&P 500 futures or ES, which is currently trading at maybe about 5,700, will rise moderately in the near future after the elections. So you see resistance at 6,000 and support at 5,400. So what you can do is to execute your bull call spread based on your support and resistance. You long in the money call option with a lower strike at your support level of 5,400. So again, because it's in the money, you'll pay a higher premium of $300. On the other hand, you go short uh, out the money call with a higher strike of $6,000. So again, because it's out the money, the premiums that you receive will be lower. So your net cash or your net premium position will be a net outflow or debit of $250. So you are paying $250 in form of premiums. And for bull call spread, your break even will be calculated by a lower strike. Lower strike meaning the long in the money call plus your cash outlay. Cash outlay referring to your $250 debit premium. So for bull call spread as well, your maximum loss will be your net cash outlay or the premiums paid of $250. And this will occur because both options will be expiring worthless. On the other hand, the max profit position can be calculated by a strike difference, and then you minus your net cash outlay. So in this scenario over here, we see that the maximum loss is $250 and the maximum profit will be $350, and this occurs when both options will be exercised. So again, what's the benefit of doing a bull call spread when you can very simply just go long call? Firstly, it will lower your break-even point. If you only purchase the call option, the break-even point would be a strike plus premium. It will be $5,700. Now it's $5,650. So a lower break-even point means that it will be easier for you to make profits. On the other hand, a bull call spread also lowers your net premium, and this is what I mean when I say that it helps to lower the cost of entering a trade. If you only purchase the call option, the total premiums that you pay would have been $300. With a bull call spread, you only need to pay $250. So you're essentially lowering your cost of entering a position. And the final benefit of this bull call spread over a long call position is that you'll lower your maximum loss. If you only purchase the call option, your maximum loss will be at $300, but with a bull call spread, your maximum loss will be $250. So these are certain benefits of a bull call spread as well as other vertical spreads as well. So let's go through an example. One other example. Let's say we have COMEX Gold Futures. It doesn't matter the contract month. Let's say the current spot price is $2,740, denoted by the blue line over here. And remember, to execute a bull call spread strategy, you have to go long and in the money call at a lower strike. So this is our lower strike position. And because it's in the money, we pay a higher premium of $250. On the other hand, we also have to short and out the money call at a strike of $2,900. So it's given over here, and because it's out the money, your premiums received will be $50. So your net debit position will be $200 paid or outflow for your premiums. So again, maximum loss for a bull call spread will be your net premium paid, and this occurs when the underlying price, which is given by the x-axis, when the underlying price goes below your lower strike. So over here on the chart, you can see that maximum loss will occur when the futures price or forward price goes below the lower strike of $2,500. And in this scenario, both options will become unexercised. They'll essentially expire worthless. And the max profit, which is over here when your underlying price goes above your higher strike price. So when it goes above $2,900, both options will be exercised because remember, a call option, you exercise it when the underlying is above the strike price. With a call option, you are bullish in the market, you want the underlying to go above the strike price. So for max profit, you can calculate it by taking the difference in strike. And in this case, it's 2,900 minus 2,500. So it's $400, and then you simply deduct your net cash outlay of 200. So your max profit will be $200. You can see this chart over here. So it gives us a max profit of 200, the horizontal line over here. And on the other hand, the max loss will be $200. So let's go through again different scenarios. If it rises to 2,900, as I mentioned, both calls will be in the money. Your long call will be exercised, and your short call will be assigned. So your max profit will be strike difference minus your overall cash outlay. So it's $200. But if it's between 2,500 and 2,900, it can be a profit or loss. It depends on how high above the lower strike your underlying price is. You can see over here, again, this will depend on your break-even price, which is why your break-even is important to calculate. In this scenario, the break-even, which I've calculated, will be about $2,700. So if the underlying, for example, gold, if it doesn't, if it's at 2,600, you still won't make a profit. If gold is at 2,600, you'll make a loss of about $100. So you only make a profit if gold goes above 2,700. And of course, if gold goes below 2,500, both options will be worthless, and you will have a maximum loss of, based on your net cash outlay, of $200. So we've gone through bull call spread. Let's talk about bull put spread. Without going too deep into or elaborating too much, essentially a bull put spread is very similar to a bull call spread. The difference is that instead of it being a debit strategy, it's a credit put spread. And when we say credit, it means that it's a net cash inflow. Cash flow is positive because you are selling an in the money put with a higher strike. So again, you are selling a in the money option. So the premiums you receive will be higher. On the other hand, you're going long on an out the money put. So the premiums that you're paying for your out the money put will be lower. So your total cash flow will be positive. So for this trade, you'll receive premiums. And that's one of the benefit of a bull put spread as well. So to execute this strategy, you can go long and out the money put with a lower strike, and short and in the money put with a higher strike. So in this scenario, it's the same as the previous one I mentioned. You believe that the E-mini S&P 500 futures will rise moderately. What you can do again is to execute a bull put spread. Again, the break-even price for bull put spread is calculated differently. You have to take the higher strike price of 6,000 minus the net cash flow of $5,650. So at this point, I believe it could be a little bit too content heavy, but don't worry because I'll summarize all the different formulas, actions, how to execute strategies on one page later on. So for bull put spread, the maximum loss will be when the underlying is below your lower strike price, and this will happen when both options will be exercised. On the other hand, you will see the max profit when your underlying is above the higher strike price. So again, it's pretty similar to a bull call spread. You can see that the profit and loss diagram is essentially the same. But the difference is that a bull put spread is a net credit strategy. So when you compare it to a bull call spread, where you are essentially paying premiums, a bull put spread means that you'll receive premiums. And that's one big difference between the two strategies. So again, going through different scenarios. Let's say in this case, gold rises to $2,900. At this point, both puts will expire worthless. Why? Because put options they'll only become in the money if the underlying drops below the strike price. So anything below the two strike price will be seen as in the money. So because they expire worthless, your maximum gain will be your proceeds from your premiums. In this case, it's $250. So between 2,500 and 2,900, which is the two strike price, again, this will depend on how much your underlying price moves. For example, if gold falls to $2,600, you will still see a loss of about negative $15 because your break-even point is only at $2,650. And on the other hand, let's say gold falls below $2,500, your maximum loss can be calculated with this formula over here. You take the difference in strike price, so it's $400, and you add your net proceeds in the form of premiums. So in this case, the maximum loss will be $150. So this is a summary of the bull call spread and the bull put spread. How you construct them, there's different, it's written over here. There's different ways to construct both strategies. It's pretty similar, but you have to keep in mind the in the money call, out the money call, because this will impact your whether the strategy is a net debit strategy or a net credit strategy. And because both strategies, their main goal is that they believe the market, they expect the market to moderately increase, which is why their name has a bull, there's a word bull inside. Uh, On the other hand, there are other features as well. Remember, because it's like a Z shape, your upside is capped, your downside is capped as well. So, the max gain, max loss, and break-even points are shown over here. So if you guys do want to take a picture, go ahead. But I'll show it again at the end. And this is a summary of both strategies as well. To repeat, for a bull call spread, typically you're moderately bullish on the market. You buy an in the money call and you go short and out the money call. Your risk, your downside risk will be kept to your net premiums that you pay. Your reward, your maximum profit will be kept at the difference between the both strike price minus the net premium paid. So this is a net credit strategy, meaning that you will be receiving the you'll be receiving the premiums. On the other hand, a bull put spread, it's much of the same. You're moderately bullish on the market. You go long and out the money put and short and in the money put. And it's a net debit strategy. So now let's talk about the other side of the coin, a bear call spread. Right off the bat, you can see from its name, a bear call spread means that you're bearish on the market. And it's also known as a credit call spread, which means that you'll be receiving premiums, not paying them. So again, your risk and reward is limited. You can see that when you compare it to the bull put and bull call spread, the shape of the P and L diagram is very different. Instead of a inverted Z, right now it's an actual Z shape. And what you can see is that your risk and reward again is also limited. So how do you execute a bear call spread? You go long and out the money call with a higher strike, and you short and in the money call with a lower strike. Again, because it's a credit strategy, your cash flow will be a net cash inflow. Maximum loss will be given by the strike difference minus the net premium received, and your maximum gain will be your net premium received. So for this example, again, I'll be using COMEX Gold Futures. Because it's a net credit strategy, you'll receive $250 in terms of your premium. So the maximum loss, which is over here, you can see it occurs when the underlying price of gold is above the strike of your long call position. Meaning that if your underlying price, for example, gold, if it increases, you will face losses. So it's the opposite of a bull call spread, where you will benefit on if the you'll see profits if the price goes up. On the other hand, for a bear call spread, you will see max profit when the underlying is above the strike of the short call. So there's different scenarios. Firstly, let's say gold rises to $2,900. What happens is that you'll gain on your long call position, but you will lose on your short call position. So the maximum loss is given by this formula over here, the strike difference plus your net premium, and what you'll get is $150 in terms of your maximum loss. You can see that the graph also corresponds to $150. And if gold is between 2,500 and 2,900, again, this will depend on your break even. Break even point is given by lower strike price plus your net premiums. So your for bear call spread, you will only see profits if the underlying goes below $2,750. Lastly, if gold is below $2,500, this is your maximum profit point, where your both call options will be worthless, they'll expire worthless, and your maximum profit will be limited to the net premiums that you're receiving. Lastly, the last vertical spread will be the bear put spread, and it's also a debit put spread, meaning that you are paying cash, you are paying premiums instead of receiving. So again, the view for such a strategy is the same. You're moderately bearish on the market. Risk and reward is limited. To execute this strategy, you go long in the money put with a higher strike and short and out the money put with a lower strike. The net cash flow will be a debit. It's a cash outflow because it's a debit strategy. Maximum loss and the maximum gain is essentially the opposite of a bear call spread. So using gold as an example again, we see that the net debit premiums, you're paying $250 in terms of your net cash outflow. Maximum loss will come when underlying again goes above the strike of your long put position. And the maximum profit is the opposite when your underlying is below the strike of your short call position, which is over here. So again, different scenarios. Let's say gold rises to $2,900. Both your put options will be worthless because again, when options are in the money, put options are in the money when the underlying is above the strike price. So in this case, because gold is at $2,900, both your puts will expire worthless. So maximum loss in this scenario will be your net premiums paid. If it's between 2,500 and 2,900, you need to take into account the break-even point, and whether you make money or whether you make profit or not will have to depend on whether your underlying price goes below the break-even point. You can see it right over here. You start to make profit essentially as soon as the underlying goes below $2,650. Lastly, if gold goes below $2,500, this means that both puts will be in the money because the underlying actually goes below your strike price. And the maximum gain will be calculated by strike difference minus your net premiums paid. So this is a vertical spread summary for the bear call spread and bear put spread. It's pretty much very similar to a bull call spread and bull put spread. Uh, Other than the fact that the view for both strategies is that you expect underlying assets price to moderately decrease. It's the opposite of the bull spread strategies. Bear call spread, it's a net credit strategy, while bear put spread is a net debit strategy. So do take a picture if you guys are still confused or you need some further clarification, or if you want to remember this strategy as well. So to summarize a bull call spread, how can you execute it? You have to go long in the money call with a lower strike price, and at the same time you short and out the money call with a higher strike. This will be a net debit strategy. On the other hand, we have a bull put spread where how you execute it is you have to go long and out the money put with a lower strike. At the same time, you have to short in the money put with a higher strike. So it's a net credit strategy. On the other hand, we have a bear call spread as well as a bear put spread. It's essentially the opposite of your bull spread strategies. So don't worry if you guys need to take a photo. At the end of the presentation, I'll show all these slides of all the different formulas as well as the summary of the key points of each strategy. So now we move on to the second last section of this webinar, using option strategies in different in current market conditions. So unlike spreads, we also have what we call option combinations. Unlike the previously mentioned option spreads, with an option combination, typically one leg will be a call and the other is a put. Again, this is different because remember your bull call spread and your bull put spread, you are essentially using two same options. You long and you short one call, and you long and short another call. On the other hand, option combination, you essentially combine a put and a call, and both are long or both are short. So it's pretty different from option spreads or vertical spreads. And you can see that the universe of option strategies is very, very wide. There's no way I can cover all of them. There's a lot of different strategies, as I've mentioned, butterfly spreads, condor spreads, we have diagonal spreads, risk reversal, synthetic forwards. So all these strategies as well, if you guys are interested, you guys can take the time to find out more about them in your own free time. So now let's talk about probably one of my what I find the most interesting and something very unique about options is that they allow you to tap into what we call market neutral strategies. So market neutral strategies are used when an option trader does not have a view on the underlying asset. Most of the time, sometimes when people, we may own an asset, but we don't really have a view on where the price will go. We don't really know whether it will go long or whether it's bullish or whether it's bearish. So we don't have a view, but with options, we can do what we call market neutral option strategies. And these are essentially non-directional strategies because the potential to, or how these non-directional strategies profit is that it depends on how much the asset moves, not its direction. So what I mean by that is that these market neutral strategies, it doesn't matter, let's say, if the underlying price drops or whether it increases. What matters is how much it increases or decreases. So in this case, you can profit if your market neutral setup, if you can profit if it decreases or increases large enough. So again, the ideal outcome for such a strategy is for the put or the call to increase far enough to offset your premiums that you're paying. So there's two ways. One is that you're bullish on volatility, and this is where straddle and strangle strategies comes in. So typically it's used when a trader, when you're uncertain about the direction of the market, but you believe that volatility will increase. You're very bullish on volatility, and this is where I would say is the best time to use a straddle or strangle strategy. On the other hand, we have strategies that are bearish on volatility. So you believe, again, you have no view on the direction of the market, but you believe that volatility will be very low, markets will be very flat, they'll be very quiet, and they'll be very calm. So in this scenario, it's best suited for short strangle strategies, condor, or butterflies. So let's dive deeper into market neutral strategies. So firstly, let's talk about long straddles. So how do you execute this strategy? You go long and add the money call, and you go long and add the money put. So you can see right off the bat on the right hand side the profit and loss diagram. I believe you can see from here that you will essentially profit when the underlying decreases far enough, and also you also profit when the underlying increases far enough. So your upside is potentially unlimited, regardless of whether it decreases or increases, as long as the move is big enough. And that's something very unique, I believe, about this strategy. On the other hand, your maximum loss is limited to your premiums paid. However, something I like to highlight is that the premiums that you're paying for these market neutral strategies, they are typically higher than the premiums that you're paying for your normal strategies. Why? Because you have two option positions. You're going long on two different options, so you're paying twice the premiums. So again, the key to profiting is to have the underlying asset move big enough or move far enough to offset the premiums that you're paying. And this is why I mentioned earlier today that sometimes for option traders, volatility can be your friend, not your enemy. So again, straddles are used when an option trader is bullish on volatility and you expect the underlying security. It can be gold, it can be oil, it can even be your S&P 500 E-mini futures contract. You believe that they'll experience significant volatility in the near term. So let's take a look at an example. You believe that the E-mini S&P 500 futures, which is currently trading at 5,700, will see heightened volatility after the elections. Why? Because maybe Trump decided to increase or impose more severe tariffs on, let's say, China and other trading partners. So because of this heightened volatility, this is where we say it's a good time to execute a straddle strategy. And in this example, how do you execute a straddle? You have to buy and add the money call and buy and add the money put. Again, your net cash outlay will be your call premium and your put premium. So you're essentially paying two premiums, and your break-even point, you essentially have two break-even points, the underlying price minus your net cash outlay, and your underlying price plus your net cash outlay. So again, using the E-mini S&P 500 as an example, in our current price will be 5,700. So we long and put, we long a put and we long a call at 5,700, and our net cash outlay is $200. So several scenarios. Let's say the E-mini S&P 500 rises above 5,900. Let's say it rises to 6,200. This means that your call will be in the money and your put will be expiring worthless. So your total profit will be $300. And this is potentially unlimited depending on the magnitude of how much the underlying moves. On the other hand, let's say the E-mini 500, S&P 500 drops to 5,300. This means that your put option will be in the money and your call option will be expiring worthless. So you can see that even if your underlying drops, you still make a profit of $200. So this is why we say that it doesn't matter the price direction. What matters for straddle and strangles is the volatility and how much the underlying price moves. Of course, you will see maximum loss if your underlying price remains unchanged at 5,700, which is over here, which is essentially the tipping point of this V-shaped diagram. On the other hand, we also have a very close cousin of the straddle strategy. We have a strangle strategy. So it's very similar to straddle, other than the fact that you buy an out the money call and you buy an out the money put. And you compare it to the straddle, where you are essentially you buy an at the money call and you buy an at the money put. On the other hand, strangle, you buy an out the money call and you buy an out the money put. So very similar to a straddle, your upside is potentially unlimited depending on the magnitude, not the price direction. One difference is that the maximum loss occurs between both strike prices. So this is a key difference between straddle and strangle. So again, as an example, let's say you believe that gold may be volatile after tonight's election, because Trump election victory may increase trade and geopolitical tensions. So you expect gold prices to be very volatile, maybe tomorrow or for the remainder of the week. And doing some technical analysis, let's say you have resistance at 2,900 and you have support at 2,500. So how you can execute this strategy? You simply, uh, you know, long and out the money call at resistance of 2,900, and you go long and out the money put at resistance of 2,500. So again, you can see that your net cash outlay will be a total of $15. So you need to pay double the premiums. And your break-even price can be calculated by deducting your net cash outlay and plus your net cash outlay. So going through different scenarios, let's say gold rises to $3,000. Your call option will be in the money, your put option will be expiring worthless. So total profit you make will be about $85. You can track the P&L on the chart I provided. If gold is at $3,000, it will be around over here, which is $85. If gold drops to 2,300, which is probably the far left of the chart, you can see that you will still make a profit of about $185. So again, it really doesn't matter the price direction. What matters for straddle and strangle is the magnitude of the move, which depends on how volatile the market is. So on the other hand, let's talk about short straddle or short strangle. And this is really the opposite of a straddle and strangle strategies. And your main view is that you expect volatility to be low and you believe that the underlying price will remain flat and range bound. So prices will move, prices will remain flat, maybe they'll increase by 0.2%, 0.3%. And you can see that the chart is essentially upside down version of the strangle. So how do you execute this strategy? You very simply, instead of going long on a call and a put like you did for a strangle, you short and out the money call and you short and out the money put. So because you're shorting options, you'll receive premiums, and again, the premiums that you receive will be double. So because you're receiving a call premium and you're receiving a put premium. Therefore, as long as the underlying asset price stays within both strike prices, you, as an option writer, will get to keep the full value of the premiums that you're receiving. And this is best when volatility is low, or if you believe that markets remain flat or range bound. So again, using COMEX goal as an example, this is one possible way to execute this strategy. However, one risk of this strategy is that your risk is unlimited. Why? Because there is no, as I've mentioned, your futures price or gold prices can theoretically increase to infinity. And you can see again that the P&L line essentially extends to infinity over here. So we've gone through the other sections, and now I'll come to the summary and conclusion of today's webinar. So to summarize the different option strategies, it can be classified into three different strategies. Firstly will be option spreads or vertical spreads. And essentially, vertical spreads refer to two similar options. So two calls or two puts, and you go long on one of them and short the other. So expiration date will be the same, and however, the strike price must be different. You can think of vertical spreads essentially as directional bets. Remember bull call spread, bear call spread, but it comes with lower risk and lower reward, as well as lower cost. So a debit strategy, as I've mentioned, will be a net cash outflow. Credit strategy will be a net cash inflow. On the other hand, we have option combinations where one leg will be a call and the other will be a put. So you go long on both of them or you short both of them. And typically we refer to these strategies as market neutral. So it doesn't depend on the direction of the market, but it depends on the volatility of the market. If volatility is high, you will go long a straddle or long a strangle. If volatility is low, you will short a straddle or you short a strangle and continue to receive premiums. Lastly, I've also covered last month and a little bit today of option strategies with an underlying position, such as covered calls, protective puts, and collars. So if you guys want to take a photo, you can take them now. Just to re-summarize, a short call strategy or a naked strategy, typically you do it when you're bearish in the market. So you very simply you go short on a call option. Your reward is limited only to the premiums. You can see it through the P&L line over here. Yeah, it's essentially horizontal, which means your reward, your maximum profit is capped. However, your risk is unlimited because theoretically the underlying can increase to infinity. On the other hand, a covered call will include a short call and a long underlying position. So it can also be you already hold an underlying position, for example, in gold futures, and you add a short call position because you want to earn additional premiums. So one benefit of a covered call is that you have some upside participation because you are long and underlying, and at the same time you also receive premiums. However, your maximum profit is capped. So if you believe that the underlying price, let's say gold, you believe very strongly that it will go above $3,000, so it will probably be better for you to very simply just go long a call option rather than a covered call. However, if you believe that let's say gold maybe they will rise to about 2,900 and you're mildly bullish in the market, it could be better for you to do a covered call and so you gain some upside participation while at the same time receiving additional premiums. So the maximum loss, again, it's not infinity, but it occurs when underlying goes to zero. So we have protective puts. Like its name suggests, you're protecting your underlying position. So you protect against losses. You can see over here in the P&L diagram, your maximum loss is limited. And then we have option collars. Option collars can be a costless collar if the premiums that you're paying and the premiums that you're receiving offset each other. And these option collars, they are limited risk and limited reward. Typically, we aim to reduce the cost of our entering the position as well as to protect our profits. So now we come to bull call spread and bull put spread. These are all vertical spreads, meaning they are the same options with different strike prices. A bull call spread is also a net debit, meaning that you are paying premiums, while a bull put spread is a net credit strategy, meaning that you will be receiving premiums. So to execute a strategy, it's very similar but at the same time very different. For a bull call spread, you have to go long and in the money call and short and out the money call with a higher strike. So I hope you guys have taken a photo of this. And of course, we also have a bear call spread and a bear put spread. And like their name suggests, bear call spreads and bear put spreads, you do them when you're moderately bearish on the market, and the benefits are the same. You can reduce the cost of entering a position, and you can use it to protect profits, or if you're moderately bearish on the markets. So hopefully you guys have taken a photo of this as well. Now let's talk. Then these are the strategies that I addressed. These are all market neutral strategies. So both straddles and strangles. The correct term will be long strangle and long straddle. The best time to execute them will be when you're unsure on the market direction. For example, tomorrow, let's say it's after the elections, you're very unsure on the market direction, but you expect to see high volatility, depending on who wins the election. So a straddle strategy, you go long at the money call, and you go long at the money put. Your maximum loss will be your net premiums paid. Maximum gain will be unlimited. And the only difference between a straddle and strangle is that instead of long in and at the money call and out at the money put, you go long and out the money call and out the money put. And your maximum loss occurs within a range rather than a single price point. So lastly, we come to a short strangle strategy, and you can see that it's the opposite of a strangle strategy. The best time to execute them will be when market volatility is low, or when you believe market will be flat and range bound. So you do the opposite of a strangle strategy. You go short and out the money call, and you short and out the money put. So you will receive premiums. Again, you'll receive double the premiums because there's two option positions. However, your maximum loss is unlimited because, theoretically, the underlying price can extend to infinity. So, I would like to end the slide again by referring back to one of my earlier slides. Why should we use option strategies? I believe I've gone through all of these points. I've gone through risk management. How vertical spreads provide us a lower cost way to long or short the market, and how market neutral strategies like straddles and strangles allow us to profit in any market conditions. Strategies like covered calls provides us with income generation, and of course, option strategies, they can be tailored to fit different market outlooks. And with that, I'd like to end this presentation. Thank you for listening. Apologize if today's webinar is a bit too content heavy, but do feel free to extend us, give us your questions, and I'll try my best to clarify them. And I hope you've taken the pictures because they are very important. So again, if you want to contact me, or you are looking for the slides, do feel free to send me an email, or you can simply call us at my office hotline. It is given by this number over here. So now I'll be moving on to the Q&A session. So let's address some questions that the audience may have.
Yeah, members of the audience, I just want to do a quick update. The webinar is recorded, so if you'd like to catch up on the insights shared by Danish, you will have a link to the video recording so you can catch up at your own time. All right, I understand sometimes if you're new to options, it could be too much to take in at one go. So, watch the video and take your own time to understand the full concept. All right, Danish, over to you for the Q&A.
Okay, so let me just address some of the questions over here. So let me address a question by B. Eng Eng, who I believe the question is asking what I meant by simultaneously. For example, when I talked about a long straddle strategy, whether simultaneously means I have to long call and long put on the same day. And the person asked whether I can long a call today, and then a few days later I long a put. So the answer to this, I think, I mean, you can go long or put on another day, but you have to make sure the certain factors, for example, expiration and same strikes. Those are the two key factors. Simultaneously, I believe it's probably the wrong word. Uh, what I meant is that you need essentially to have both positions. Yeah, it doesn't refer to the timing. It just refers to having both positions at the same time. So yes, I think short answer is that yes, you can long a call today, and then a few days later you can long a put. But there are some, I would say there's some minor differences. Possibly maybe the premiums that you're paying could increase or decrease, but the fundamentals are the same. It's probably more important for the strike price to be the same and same expiration. So I hope that answers your question. So I think there's another question from Vivian, who said that it's very overwhelming for newbies to options. What is the easiest way to get started? Yes, I believe this was one of my concerns when I came up when this webinar topic was proposed to me, because these are option strategies that are typically aren't for beginners. In fact, I believe statistics have shown that I believe over 70 or 80% of option traders, mainly most option traders, they very simply go one direction, or they have just one leg. One leg meaning they just long an option or short a call, long put, short call. At the very most, some of the more advanced option traders, they probably have two legs. The very popular strategies will be covered calls or protective puts. Protective put is probably one of the strategies you hear quite often, because you have a long position. Maybe let's say you already have a long S&P 500 futures, and you want to protect it. You believe within this week, election week is very volatile, and you want to protect your underlying long position. So you just go long a put, so you can protect it in case the market falls. You can still profit. So if if I were to answer the question, what is the easiest way to get started? There's two ways. First is to start trading options yourself. Of course, the best way to learn how to trade options is to, dive deep in it, put your hand to work and see, and learn from your mistakes. And of course, another way would be to, do your own research and stick to the strategies I've mentioned. Go with one leg strategies like long call, short calls, protective puts, covered calls, strategies like that. Typically, straddle strategies, strangle strategies, on the bull call spread, or things with multiple legs, typically are more complicated. It's typically done by advanced or very very experienced option traders or institutions. Yes, so I think the easiest way to get started is to start trading yourself, and instead of doing the more complex strategies, do the more simple one leg strategies. So I hope that answers your questions. So I think there's another question from Vint T, who asks whether we have a course on these strategies. So to answer your question, I'm actually not very sure whether we have a course. Maybe Sri, you can help me out with this. I'm not sure if we have a course from this. Yeah, but if you are also interested on these strategies, do you can look forward to some of our future webinars as well. And I believe we may still have the recording for last month's webinar, right? Sri?
Yeah, Danish, I think you brought up some good points there. Okay, so Philip, we are a firm believer in education. Our recent options webinars, including the first part of this series, is available in our YouTube channel. I'll send it into I'll reply you with the link to our YouTube channel. Additionally, there's another option for you if you don't already have an account manager. You can also sign up for a free it's a free one-to-one coaching session with our experienced trainers, and then you can get that one-on-one guidance that you need to learn more. So you have video recordings which you can refer to, or you can also sign up for free one-to-one coaching and learn more about how you can get all your questions answered from an experienced trainer, and then take it from there. Okay, so I'm gonna send in the link to our YouTube channel in the chat, and then I'll also send the link to our one-to-one coaching page. um, into the chat as well in case you wanna sign up for one-to-one coaching session. So I understand it's can be quite daunting for beginners. So if you want an experienced hand walking you through the ropes, or if you prefer to ask your questions to Danish himself, you can. Like there are several options for you to learn more about options trading. Okay, so I've added the two links to the chat. You can head down there and grab the links. And if you have any other questions, you can always send them to us in our post webinar survey, or you can always send a note to us in the email addresses provided, or contact us. Um, via our website, and we'll get in touch with you and have your questions addressed as well. All right, thank you so much for being a wonderful audience. We will be having regular options webinars, and I understand there's a lot of you who are keen to learn about options trading. So do look out for future options webinars. Best to follow us on social media so you can stay up to date with what we have planned for options trading. Danish, is there anything else you would like to share with the audience?
Um, no, not really. I think for all the traders out there, just outside of options, it'll be of course it'll be good to monitor regular market events, and sometimes reading the news, you could see a situation. For example, as I've mentioned, U.S. elections or whatever, when markets are very volatile, and suddenly it may one day pop into your mind, oh, markets are volatile, but I'm not sure how do I trade, whether do I go long or do I go short. And I hope after today's webinar that when such a question comes to your mind, you will think back that, oh, I can try to execute a straddle or strangle strategy. And that's just one example of the benefits of making an effort to learn all these option strategies. Because I believe it gives you, it'll give you guys a wider tool to essentially make more money. Yes. So yeah, I hope you guys, if you guys are really more interested, do look forward to our future webinars. I believe Sri will send you guys the slides, and I hope you guys have taken the pictures of the summary slides I showed and all the different maximum gain, maximum loss, because I believe and I know it's very content heavy. Probably tomorrow you guys will probably forget about all this, but if you guys want to remember, just take a look at your photos or at the slides, which we will definitely send to you guys after today. Yeah, so thank you for coming, and thank you for listening throughout.
Yeah, so just to add on, we'll send you a link to the video recording. The webinar is recorded, so you can catch up on the insights shared at your convenience. Okay, so anyway, before I leave, there's something to look forward to starting tomorrow morning. We have the U.S. elections kicking off tomorrow morning. Just make sure you plug into the radio and stay up to date with what's going on while you're at work. And yeah, so if there are any questions, just send them our way. Have a good night and all the best for your trading this week. Good night. Thank you, Danish.
Thank you. Thank you, guys.